Are you curious about bonds and how they work? If so, you've come to the right place. In this video, we'll demystify the topic of bonds and explain everything you need to know in a straightforward and easy to understand manner. So what are bonds? Bonds are debt securities that allow individuals to loan money to an organization, such as a corporation or government. This is in exchange for regular interest payments and the eventual return of the principal. In other words, when an organization needs to raise money, they issue bonds, and you, as an investor, can purchase these bonds and lend the organization money. So how do bonds work? When you purchase a bond, you are essentially lending money to the organization that issued the bond. In return, the organization agrees to pay you periodic interest payments based on the agreed upon interest rate. For example, if you purchase a bond with a 5% coupon rate, you will receive 5% of the bond's value in interest payments each year until the bond matures. Bonds have a set maturity date, which is the date on which the bond issuer is obligated to repay the bondholder the full amount of their money. The interest rate on a bond, known as the coupon rate, remains fixed for the life of the bond. It's important to note that the coupon rate is not the same as the yield, which refers to the return on your investment based on the current market price of the bond. Is it like stocks? No, unlike stocks, bonds are generally considered to be less risky investments. This is because bonds offer a more stable source of income through the periodic interest payments. However, bonds also offer lower returns compared to stocks. So, if you're looking for a more stable source of income, bonds may be a good option for you. On the other hand, if you're looking for higher returns, you may want to consider investing in stocks. There are several types of bonds, including government bonds, municipal bonds, corporate bonds, and more. It's important to understand the differences between these types of bonds and the associated risks. Additionally, you should also be aware of the factors that can affect the value of a bond, such as changes in interest rates and the creditworthiness of the issuer. In conclusion, bonds are debt securities that allow individuals to lend money to organizations in exchange for regular interest payments and the eventual return of the principal. While bonds are generally considered to be less risky than stocks, it's important to understand the terms of the bond, the associated risks, and the different types of bonds available. With a basic understanding of bonds, you can make informed investment decisions and diversify your portfolio.